In this video, I'm going to talk about the difference between being an investor and being an accountant. So nowadays, I see a little bit of people with accounting knowledge that come out and say certain things about various different companies. And I saw, for example, Strongman Personal Finance, read financials, which is a very good read about various different companies. And then I see other people saying certain things about, certain companies, like let's say Aduro or Voxter, using their accounting knowledge, right? And there, as an investor, I do think it's very important to know how to read financial statements. That's why I wrote the book, The Basics of Understanding Financial Statements. But investing is not just about reading financial statements, okay? Because if it was reading just financial statements and understanding financial statements, then all the accountants would be the richest people in the world. And it's not like that, right? So think about, for example, the business world. Think about the guy that owns a gas station, or think about a guy that owns an auto repair shop, right? So let's take like an auto repair shop. He knows how to fix cars. He knows how to source parts to fix your car, where to get them the cheapest, the kind of people to hire to turn it around very fast and all that. If you ask that kind of guy, what about your accounts receivable? Or what about your accounts payable? Or what about your deferred revenue? He's going to look at you and think like you're from a different planet, right? He doesn't know anything about those kinds of things. Or somebody who owns a hair salon. They don't know anything about it, right? That's why those people hire accountants, CPAs, certified public accountants. They hire them because they don't know anything, right? And then accountants put the financial statements together for them. Those business owners don't even know how to do their own tax returns most of the time, because they know how to do their business. They might be successful at their business. Or for example, the guy that started Walmart. I mean, can you imagine him understanding a FIFO, first in, first out, or first in, last out, on inventory, or accounts receivable turnover and all that? They don't understand any of that, right? So he understands like, okay, I know where to get all the produce from, how to build a store, and how to be successful, right? You see, the mindset of an investor, the mindset of a hustler, the mindset of a business person versus the mindset of an accountant, it's like they don't really go hand in hand together, right? So I see this a lot, that now people, especially that the stock prices of certain stocks go down, they start going through financial statements and they start saying, oh, this stock is down because of this, and this on the balance sheet or on the income statement. And just because one thing happens after the next doesn't mean that A causes B, right? If you ever took logic in college or whatever, you know that just because A happens and then B happens doesn't mean that A is caused by B. Okay, it's not like that. So I see this a lot right now, because stocks of everything is down, and then they're like, oh, because they're burning cash, or because they're not profitable, or because of this or this on the balance sheet. It's complete nonsense, right? And now, if I give you an example of something like Oracle, for example, they don't have any revenues, right? They don't have any revenues at all. I mean, they have a small royalty, but they don't have any revenues. And so if you took an accountant and you showed an accountant the financials from Oracle from 2017, when I got involved, they would have told you to stay away. It's too risky. They don't have any revenues. They're burning all this cash, and they would have stayed away, because accountants, are risk averse. They're used to looking at profitable companies, right? And they would have told you to stay away. But there was so much more to Oracle's story than just looking at the financials. Yes, looking at the financials was important to figure out how much cash they have, but the value of Santa Thomas wasn't in the financials, right? The value was in understanding the story behind it. The value was an understanding of why they were going to win the legal battle. Why? Understanding how the legals were in 3 different jurisdictions, following the legals, that's where the value was. It wasn't in the financials, right? The same thing when you look at something like Aduro. You show it to an accountant, and he's like, "Oh my goodness, they don't have any revenues. They're burning this much cash. You should stay away from it because it's going to go to zero." Well, there's more to Aduro than just financials, right? It's the technology behind it. What kind of problem they're solving? How does their technology compare to other technologies, right? Why is this such a big deal? What kind of parties are involved? Who did they sign partnerships agreements with? And why, right? You get on the phone and you talk to the CEO, you talk to the competitors, you do your scuttlebutt, you understand the story. It's not shown in the financials, right? And now if we look at something like Voxtur, if you look at the financials from the Q3, for example, that they showed, then you're like, if you're an accountant, you start panicking. It's like, oh my goodness, they have only $12 million of cash. They have trade receivable that, who knows if it's going to be paid back. Then they have, a long-term debt, 60 million of long-term debt that's in the current liabilities. Oh my God, in the current liabilities, it's due within 12 months. How are they ever going to be able to repay it? That's, again, not shown in the financial statement. That this is not a problem. Why is this not a problem? Because we have Bank of Montreal involved. Why isn't this a problem when the Bank of Montreal is involved? Because of the human relationship that Gary has with Bank of Montreal, how he made them $500 million with his other company. So they're going to work with him, and they worked with him so many times, and that's why they adjusted the covenants. And if you looked at the balance sheet, you panicked. If you understand the situation, you understand that they solved this issue. The covenants got adjusted, and then that current liability will become now a long-term liability. That's already a fact. That's already been solved. But if you understand the story behind that is not in the financials, you would have understood this. And also, when you just look at the financials, and you see, the quarterly revenue went down from this to this to this, you might be like, oh, this is not a growth company anymore. So therefore, it shouldn't be valued this way because look, the revenues are going down. But then you have to understand it how that information is in relation to the competitors, right? Competitors got absolutely killed, and Voxtur went down only this much. Why? Because the whole market, the whole industry collapsed. And then this slight decline is actually a huge victory because this slight declines means that they actually grew clients. They added clients. And then all of those clients had lower volumes, right? And then if you understand that, then you realize, yes, just because the revenues decline a little bit doesn't mean that this company is not a growth company, because it is a growth company, but it has a little bump in the road. And then you also understand it is that what are they doing within the company? That's, again, doesn't show on the balance sheet, doesn't show on the income statement. What are they doing? They're putting together different companies together, and then they're putting together different products, and then they cross-sell them. And so the current depression in the industry on the financials makes it look like the company is not growing. But if you understand it from the fundamental perspective that goes way beyond reading the financials, you can actually understand that, yes, they are growing, but it is not visible. Just to somebody that looks at the financials like, oh, I found out it's not growing anymore. You see, there's much more to it. So So now it's easy to listen to people in this market, and it's for any company. It's easy to listen to people that sound smart because they know how to look at the financials. But there's more to it, because accountants just look at the way it is with what do you call this? I don't know. I don't even know what the hell you call this. They can't see. They don't understand how business owners are there to solve problems. Okay, that's what businesses are. The revenues that a business generates is not just some random number. It's a proof that the company solved the problem for somebody else. And that's how entrepreneurs and business owners think. They think in terms of solving a problem, giving somebody a solution, and not just pointing out a problem. That's what accountants do. Accountants see and point problems. True business owners, they see the problems and then they try to come up with ways to solve them. And just because there is something problematic that shows up in the financial statement doesn't mean that this is the end of the world. It could mean that this is the end of the world. That's why you have to understand the business, but it could be an opportunity to solve a problem, to create value. So if everybody right now is complaining about, there's a debt, it's in the current liabilities, by solving the covenant, they solve that issue and they move it from current liabilities to long-term liabilities. That's an opportunity to add value. If trade receivables with a related party are a problem, this is an opportunity to provide a solution. If they provide that solution, clean it up, and everybody stops complaining about it and maybe complain about something else, then that's an opportunity to maybe create value and make the stock price go up. Accountants don't think like that. Accountants like, there's a problem. So you have to understand the difference. As an investor, it's very good. You need to know how to read the financial statements, okay? But this is one of the tools that you need to do. Financial statements are not all in, all be all. Like, they're not. They're a tool. You have to understand them, but you have to also understand the fundamental thesis behind it. What is the company that is trying to do? Where are they going? And do you believe in this story? So anyway, that's the difference between being an investor and being an accountant.